Why doesn't the central bank target the money supply instead of interest rates? Let's take a look. So in a macroeconomics class, you could see that interest rates and the money supply are linked. If the central bank were to increase the amount of money in circulation, it would mean more money is available. Therefore, because there's more money available, it's easier to get a loan. And because it's easier to get a loan, well then for the same kind of amount of money that is demanded, it's going to lead to a drop in interest rates to a new equilibrium. So you cannot increase money supply without it having an impact negatively on interest rates. And we say that they're inversely related. So why not target money supply instead of interest rates? Well, there's a few reasons for that. If we look at that graph with money supply and money demand, it's the relationship between the two that will lead to the new equilibrium in terms of interest rates. And the problem is that the central bank doesn't have absolute control over the money in circulation. It could decide how much money is printed in terms of bills and coins, but it doesn't have absolute power on how much banks keep when they receive loans, when they receive deposits, and how much it loans out. So it doesn't have absolute control on the reserve ratio, which doesn't have an absolute control on the money multiplier. So because of that, for the same amount of money, paper bills, and coins in circulation, there may be more money supply or less money supply based on the money multiplier on its own. So that's kind of an uncertainty. Also, how the money demand curve moves over time is a bit of an uncertainty as well. And at the end of the day, what they want to do is they want to have the clearest message possible that people will understand. A lot of you are taking macroeconomics class. That's why you're seeing this video. And although you're taking this class, understanding all of this relationship is still tricky to understand. But understanding changes in interest rates is a lot easier to understand. So although you understand that there's a link between increasing money supply and interest rates, it's going to put a downward pressure on interest rates if nothing else changes. Understanding that interest rates have fallen by 1% and the implications on your life and your decisions is much easier to understand than to say that the money supply has increased by $1 billion. That's a whole lot more complicated to understand. So interest rates is really what at the end of the day matters to decisions by consumers and businesses on how much to spend. So by targeting that right away, it's a clear message. It's easy to understand. It does not depend on money supply and the money demand. It's that kind of situation where the message is clear, it gets across, and it acts in the way that we want. So although we're talking about expansionary monetary supply to stimulate the economy with a monetary policy that we're expanding the money supply, you could think about it as expansionary monetary policy is we're trying to expand the economy through monetary policy, and monetary policy to expand the economy is a lowering of interest rates. So although the process starts with an increase or a decrease in the interest rate, it doesn't mean that the money supply will not change. And to understand this, you could just think about it simply. If interest rates fall, that means that banks, commercial banks, if they run out of reserves and they have to borrow in the overnight interest rate, they're going to borrow at a lower rate. So it's not as costly for them. So it's easier for them to make more loans and keep less reserves just in case. Because if the rates are really high, you don't want to run out of money in the overnight market because otherwise it's going to cost you more. So that's part of it. And if rates are lower and you're able to pass that lower rate to the people that are borrowing money from you as a commercial bank, well, there's going to be more people that will want to borrow money. So through this process of lower interest rates leads to more banks making lower interest rate loans, and which leads to them keeping less reserve, which leads to, through the money multiplier process, less reserve equals more money created. Therefore, banks are increasing the money supply through this money multiplying process. So although the process started with a drop in interest rates, over time, you could see that there has been an increase in money supply. And that's why we say that you cannot have one without the other, and they're moving in opposite directions. But at the end of the day, the goal here is expansionary monetary policy is to stimulating the economy through lower interest rates or an increase in money supply. And then to contract the economy, you want to increase interest rates to slow down spending, which will also ultimately have an impact on reducing money supply through the opposite effect of what I just described. So hopefully you could understand that the two different ways can work for monetary policy, but there is clear advantages to targeting the interest rate instead of the money supply. And it's just easier to share that information to people and to have an impact. So hopefully you understand. Catch you on the next one. If you found this video interesting, please consider subscribing or joining my class where I guide you to apply and expand on the information found in these videos to real life examples. Have a good day.